If you haven't heard about smart money concepts as a trader by this point, it's likely that you aren't very active within the trading industry. Everyone and their grandmother is talking about smart money trading. But is it all that it's cut out to be? Like and subscribe to the channel. Let's analyze. Smart money concepts essentially cover how to trade like big banks and institutions. Now, my opinion of smart money is that it is actually really a good thing in theory. However, in practice, at least from what I've seen, it isn't that powerful. Now hear me out. I am saying this from the perspective of the everyday trader who's claiming to know about smart money concepts. Yet all they are doing is literally drawing random lines and zones on their chart and calling it a key level or an imbalance. What I understand about smart money is to actually be smart money. And that requires much more from you as a trader. It requires you to actually think. You need to think like the banks and institutions, which means if you're thinking like everyone else, you aren't smart money. You just, I follow the masses money. Now let me set this straight. I mean no disrespect, but if this offends you, it's probably you this video is meant for. True smart money traders approach things much differently to the masses. Let's explore some of those differences. SMC is not just a forex trading strategy. And as you know, I always say there's a difference between an analysis and a strategy, but I digress. SMC is an entire philosophy about how the markets work. Basically, SMC states that market makers, aka banks and institutions or even hedge funds, manipulate the market to suit themselves, and this will actively disrupt the way that retail conducts business within the space. My understanding of SMC is that you should align yourself with what these banks and entities are doing so that you have the best potential chance of survival. This I agree with wholeheartedly. This ideology started with a Michael Huddleston of ICT, aka the Inner Circle Trader. What I've seen is that his students, the students of the Inner Circle Trader, don't follow the real meaning behind what was taught by ICT. I want to challenge you very quickly. Let me ask you a question. Is the market mechanical or dynamic? If you said mechanical, I think you're wrong. But before I explain why, let me explain what a mechanical system is. A mechanical system is one in which it is input and rules based, meaning A will always be equal to B. In other words, the rules and inputs are constant, no change, no adjustments or adaptability is allowed. If you put this into perspective, the market is the exact opposite from this. This means that if you have purely a rules-based system, it might explain why you get really good results for a short while, but then it just starts to fail over and over. This is because the market is ever-changing and it is very dynamic. In turn, you must be a dynamic trader to adapt to the manipulations of these big entities. Ask yourself, which are you doing actively? And you would realize that if you are a mechanical trader and in your approach, even if you are using SMC, you might still be losing. In the market, you hear the term market structure tossed around loosely all the time. But what is market structure? Now, my explanation of market structure is a combination of both buyers and sellers coming together to create what you're looking at. This manifests as a constant fight between buyers and sellers that is very visible on your chart. SMC's explanation of a break of structure, from what I understand, is if price has broken a recent high or low, that means it's a break of structure. To me, that doesn't tell the whole story, because market structure is both buyers and sellers coming together to create the market. This means just because a high was blown out, the structure can still hold. It could be a fake out. The problem I have with this terminology is that you aren't taking into account all of the elements that make up the complete structure. And you don't have anything to use as a fair point of reference when it comes to that break. This is where being a dynamic trader comes in. Instead of being mechanical and just looking for a break of structure, which is not what ICT teaches, by the way. This is just what I've seen a lot of ICT students doing. Instead, try to compare what you see as a break of structure to the most recent price action on multiple time frames. You might be surprised as to what you find. I've read a few publications that suggest that many SMC traders think that they're trading like big banks, when in theory, they are still completely thinking like retail traders. Essentially, it's an old product, new packaging scenario. What does it mean to become a dynamic trader? Well, to be dynamic is to allow yourself to be open to change and progress. With the market ever changing, I think it's best to build your strategy to the scenario placed in front of you. Each trade is different, and you'd find the best traders don't have a rules-based system, but instead are constantly adapting to what they see. Now, how do you do this? It's actually quite simple. Ask a lot of questions. If we look at what a detective's work entails, his or her job is to gather information and to use that information to piece together a puzzle of the crime. How does he or she gather intel or info? He or she asks questions of and at the crime scene. I want you to teach yourself to treat the market like it's an active crime scene. Let's be real, the money is stolen from the masses daily. The masses are robbed blind daily. And what's worse is they come back tomorrow for it only to happen again. The market is a crime scene and you are the detective trying to solve the crime. The crime in this case would be, what is the market doing? Right there, you have your first question. Now this is where people get confused. They get the answer to that question and run dry. Let me ask, if you are going on a first date with someone and trying to get to know this person, you ask this person where they work and they respond with, they are a pilot. Do you leave that answer right there? Of course not. You ask a subsequent question relating to their previous answer, right? Maybe you ask, well, why did you become a pilot? Or how long have you been a pilot? The idea is to do the same of the market. So let's try that again. What is the market doing? The answer might be it's going up. So you have a new question. Why is it going up? The answer might be to trap buyers. You have a new question. Why is it trapping buyers? Maybe because the dealer wants to sell the market. But why would he want to sell the market? You have a new question. What's down there? Where is he going? Why is he doing that? This is how you be dynamic. And in theory, you can ask an infinite amount of questions surrounding your analysis. Do your work. Build out the analysis. Set your alerts and walk away. If the alert is never triggered, you never have a trade. No crime was committed, so there's nothing for the detective to do. Dynamic. I can go so much more in detail about how I do this myself, but you'd have to contact me directly for that. You can do so by reaching out to me on Telegram or Instagram at EkataTrading. I hope you enjoyed this one and implement these small changes in your approach to trading SMC if you do trade that. It's a great concept, but I think we need to try a little harder to personify what it means to be smart money. Also, click the link in the description to join the free newsletter. Comment below what you think, and I'll see you guys next week.